Hello and welcome to episode 354 of the Money to the Masses podcast without your resident host Damien Fay this week and me, Andy Leeks. Now, I'm sad to say that Damien is not on the podcast this week, but don't switch off. We've got lots of interesting content coming up and we've got lots of guests on the show to replace Damien. Well, no one can replace Damien, let's be honest. Let's get into why he isn't here. Unfortunately, he has got COVID, but good news is he's coping well, but he's just taking a few days out, as we should do when we're ill, to recuperate and recover, and he'll hopefully be back on next week's show. So let's talk about what's coming up on this week's show. We have got Harvey, Laura and Lauren coming onto the show, and it's a special, if you like, talking about how to save money on your household bills. And the reason we've come up with this as a topic for this week's show is pretty obvious, really. Cost of living is continuing to rise, as we know, and there was an announcement this week that inflation worsened in December and it's jumped up to its highest level in almost 30 years at 5.4%. So we thought, right, we've got a team here of experts. Let's go through all of the content that we've written. Let's look at areas where we can give tips to you guys, the listeners, on how you can save money on your household bills. And we'll be covering everything from credit cards, remortgaging, food shopping, mobile bills, personal insurance, pet travel insurance. But before we get to all of that, let's just quickly read out a fantastic review we received in the week. Now, the name on the review is difficult to decipher. It's DD42774. So if that's you, you know who you are. Please do contact Lauren at lauren@moneytothemasses.com and claim your free mug if that's you. And the review went like this. This is the best personal podcast out there. I decided to make more of an interest in personal finance about 6 months ago after a lifetime of ignorance. I visited many podcasts and websites recently, but this one is so far ahead of anything else I've found in terms of relevance and breadth of content. The content is clearly presented and has helped me engage with investment and budgeting in a way which has really improved my life. I wish I'd discovered it sooner and would recommend it to anyone wanting to understand and improve their own finances. So DD42774, get in touch with Lauren. Thanks ever so much for providing that review. Claim your mug. And if you want to review the podcast, you could be getting your very own Money to the Masses mug. Head over to your podcast app of choice, pop your review on there. Obviously, we'd prefer it to be 5 stars, and email Lauren and a Money to the Masses mug could be reaching you soon. So let's get on with this week's pod then. And so Harvey, let's get on to the first sort of area, really. It's your area of expertise. It's personal insurance. So welcome to the show. What have we got here?
Hi, Andy. Thanks for having me on. Yes, when we look at our household bills, and many of us are looking to cut costs and make room for what inflation is doing to our monthly bills and our outgoings, it can be very tempting. And we understand exactly the feeling when people want to cancel things like their life insurance or their critical illness cover, income protection, these types of policies, because if you haven't had to claim, it can feel as though they're dispensable, they're easy to do away with, and perhaps sometimes we even fall into the trap of thinking, well, I'll cancel it for now and I'll reinstate it later when I can afford it and make a little bit of room in my budget to bring those things back in. But what we have to point out is that life insurance, critical illness, these kinds of personal insurances don't act the same way as your other insurances. So your prices are very much fixed from the outset. And if you do decide to cancel and reinstate, you'll probably end up paying more when you go to reinstate. So it's not the wisest thing to do, but there are a few things that we can suggest to our listeners who want to cut the cost of those particular bills. So we'll start with, the easy one. If last year in January, you were one of the thousands and thousands of people who decided to quit smoking and you're now a year on and you were successful in that, then the first thing to do is call your insurer and let them know. If you're a year without any nicotine or tobacco products, then your status moves from being a smoker to a non-smoker, and that almost halves your premiums for insurances like life insurance and critical illness cover and income protection. So call your insurer, tell them that you haven't smoked, haven't used any nicotine products for 12 months, and they should be able to do perhaps some necessary checks, but they'll be able to give you a new quote and perhaps move you onto a cheaper premium, and that can immediately cut a lot of the cost of these kinds of policies.
That's a great tip. I mean, halving your premiums just from making a phone call is a brilliant tip. And how does that kind of work? Does it involve having to do that whole rigmarole again? When you take out life insurance, one of the battles we have in talking to people and getting it done, because it seems such a pain to answer all those questions, maybe the insurer has to send out reports to the doctor, and it seems to just take so long. So how does it work in terms of telling them you're a smoker? Are you effectively starting that whole underwriting process again, or is it just a tick box exercise and they do all the work? How does it work?
It's a really good point, Andy. Most people don't want to go through the arduous process of applying for their life insurance again, but it should be fairly simple. Most insurers will accept a change in status for smoking. What they may require you to do is do a simple cotinine test where they take a swab from your mouth. They'll do that at their own expense. They usually arrange it around your own convenience, so they'll send a nurse out, or there may be somewhere where you can go and have this test administered, and the results will be sent on to your insurance company. And it just really confirms that there is no nicotine present and that you've proved you're a non-smoker. And that's usually enough to move you on to non-smoker rates.
And that's key then. So it's not going to be that arduous as you've mentioned. And let's be honest, if you've got critical illness on your policy, there's a likelihood that you're paying a fair whack in premiums, perhaps even £40, £50 a month. If we're talking about halving premiums, roughly, again, you're not telling exactly what would happen, but it's kind of the broad estimation of what it would go down by. If you work that out, if you're paying £50 a month and you're halving your premiums to £25 a month, you're going to be saving £25 every month, 12 months a year. And let's say you've got 20 years left on that policy. I mean, some of these policies are long-term policies. You're talking about £6,000 for effectively just calling an insurance company and going through that process. I mean, even if it's only got 10 years left on the policy, that's £3,000, and you do the maths, it's well worth doing, right?
Absolutely. And, it's for most people that give up smoking, they've already seen a saving in their pocket from the expense of tobacco products. But it only furthers that financial benefit of giving up smoking is that you'll reduce your premiums on such life insurance policies. And like you said, some of them can be quite expensive, and halving the cost can make a substantial difference to your outgoings. So well worth doing. So
is there any other ways that people can bring down the cost of cover? Maybe I'm thinking here, they're a bit older, their life has changed, maybe they've got less debt, maybe their children have grown up, maybe they need less cover. Can they adjust cover? Is that a way you can bring down the premiums?
Absolutely. So if your circumstances have changed and perhaps you put in place some life insurances whilst your children were young and financially very dependent on you, and they've now perhaps blown the nest and you've still got these policies hanging around, review them. We make strong recommendations to review your life insurance and other illness insurance policies on a very regular basis, because circumstances do change and people's needs change, and sometimes just your priorities change, so you're not perhaps thinking in exactly the same ways as you were when you first arranged the policies. So reviewing your policies is a very good habit to get into, just to ensure that there's enough cover there's not too much cover there, but that you're paying what you need to pay, because essentially at the end of the day, Andy, insurance is insurance. It's not accumulating any value. It's not investment savings, those kinds of products that are going to return any value to us unless something bad happens. So we really only want to cover ourselves against those things we really need.
Okay, that's great. And so let's finish off this personal insurance piece then. Give us some more tips that people could do in order to save money on their personal insurance.
Absolutely, Andy. I mean, there's a couple of different things that you can do. Another, like the smoking, if your health has improved. So if your health was poor, or you were newly diagnosed with a health condition when you first arranged your life insurance policy, but that has since stabilised, or you've fully recovered, again, it's a good idea to speak to your insurance company and see whether that can be improved. That can again bring down the cost of your insurance. If your insurance was rated, that means that the premium for the insurance was increased to make room for that medical condition at the time. Sometimes not the most viable thing to do, but it's something worth considering for our listeners, is when we cover our mortgages. For a lot of people, they will cover themselves for the entire value of their outstanding balance on the mortgage, so that if either one of them, so if you have a partner and you've got the mortgage with your partner, that should anything happen to either one of you, that the whole mortgage can be paid off. Have a think about that. Perhaps consider whether one of you would be able to manage some of the mortgage by yourself. Could you split the policy into two separate policies and cover part of the mortgage each? That will reduce the cost of your policy as well. Again, not a decision to be taken lightly, something you'd probably want to speak to your advisor about and your insurance company about, just to ensure that you're doing the right thing by your own family and ensuring that other changes wouldn't affect your affordability to maintain that mortgage. Consider also reducing down the cost through shopping around. Like anything else, you can sometimes find a better deal. My only stipulation with that is that you don't cancel your policy before you've had a little shop around and checked whether the terms and conditions of the new cover are exactly the same as what you already have. But sometimes there are some cost savings to be found in that sense too. If you've changed jobs and your employer provides benefits, so if you're getting some death in service benefits or your sick pay is enhanced and you don't perhaps need the level of protection that you once did, that's another reason why you may want to adjust your cover down. Again, consider the impact of changing your job again and perhaps losing those benefits, and that not being the most sensible thing to do. But if you're fairly comfortable that you're going to be in your job for a while and you have those benefits and you'd like to reduce the cost of your personal insurances, with that in mind, that's another thing to consider as well. But I'll just say it again, don't cancel your cover. Look around, consider the changes that you can make, speak to your insurance company, see what those prices look like, compare the terms and conditions of your existing cover before you make any substantial changes to it. But there are ways to reduce down the cost of these kinds of insurances if that makes some room in your budget for the increasing cost of other goods and services that we're seeing now.
Well, that's great, Harvey. Thanks for covering off those personal insurance things. And while I've got you on, let's move on to a different subject now. Let's talk about food shopping. And this comes off the back of the news that Aldi has been named the cheapest supermarket in the UK in the latest Which report. And they've just pipped Lidl, who were close behind. And actually, they were the cheapest store for 5 months of 2021. So it was a close run thing. We know Aldi and Lidl, they are cheap supermarkets. But as cheap as they are, there was some news that hit the headlines recently. And Harvey, can you just sort of summarise a story that blew up off the back of some tweets from Jack Monroe, who's a very keen blogger in this space? And as many people may know, Jack Monroe rose to kind of notoriety because of the whole Katie Hopkins saga. Anyway, that's one for another day. But Harvey, what happened here? And are there any tips we can gain off the back of it?
So what we saw this week was a tweet that came out from Jack Monroe, the bootstrap cook, who put out a thread of tweets. And the thread of tweets really showed the real cost of goods in supermarkets and how those have increased over a period of time. And in some cases, just over the last year or two, which is really shocking for a lot of people. But basic goods like pasta going up from 29 pence for 500 grams. Today it's 70p, that's 141% increase. The cheapest rice she could find in a supermarket was 45 pence for a kilogram. Today it's £1 for 500 grams, which was 344% increase. So those figures are starkly in contrast to the 5.4% that we look at in terms of inflation. And what she's doing is she's really challenging the government to look at the basket of goods and the way that inflation is worked out by government and look at where actually people with less money, people who are perhaps closer to the breadline, are struggling more because these basic goods have increased by much more than the inflation rate shows us.
And so that's just things to be mindful of. And people hear this all the time. There seems to be a million experts out there, whether it's Twitter, Facebook, and listeners probably know most of them. But let's rattle off a few of them because it's worth reminding ourselves in January when we're all trying to sort of cut back on our spending, maybe even trim a little bit off of our waste as well. So the tips I've got here are have a look around and maybe switch supermarkets. There's always some good deals to be had. If you switch in supermarkets, you'll maybe get £25 off your first shop, especially if you're shopping online, for example. So have a look and see if you can bag any of those first-time customer discounts. This is one that always makes me laugh, but it is true because I'm guilty of it as well. Don't shop when you're hungry. It's the worst thing you can do because you literally will grab everything off the shelf. Obviously, if you're shopping in the supermarket itself, have a little look down that aisle where short shelf life goods, there's always a bargain to be had. And actually towards the end of the day, that shelf gets stocked up fairly regularly because as it moves towards the end of the day, more of the short life products will actually be moving over to that shelf. So if you go at the end of the day, you've got a chance of bagging some real bargains there, and you could even use it in your meal that evening, for example. There's always coupons to be had. Keep an eye out for coupons. And actually, when you're spending at the supermarket, don't throw away those receipts, because often on the back of the receipts, there'll be like 20% off your next shop or 10p off this. Just have a look and see what receipts you'll be given, and those little sort of bits of paper. Don't just throw them away.
And I'd say, just in line with what you're saying there, Andy, don't take your kids along. If your kids are like my kids, they throw the odd magazine, the little toy that they see lying in the impulse buy lane, and chuck it in your basket, and you end up buying things that essentially end up being lying around your house, end up in the bin, but it can cost quite a lot. One of the other things that we were talking about the other day, you and I, Andy, was the cost of deliveries. And for many of us who get our shopping delivered to our doors, the savings from paying for your delivery for a period of time where supermarkets allow you to pay in bulk for 6 months, 12 months, that can save us a lot of money, because we're not paying for that delivery charge every single time a grocery shop is delivered to our doors.
Yeah, it's a really good tip. And actually, for parents that aren't able to leave their children at home, take advantage. I know Tesco does this for certain. Take advantage of the free fruit, something to occupy them while they're coming round, so that they're not looking at the shelf and grabbing those magazines and chocolates and stuff. And I suppose to finish off, don't forget about those loyalty schemes. The loyalty schemes are there to keep you committed to that supermarket. And there's lots and lots of money off deals to be had. Make sure you download the relevant apps, because daily deals will be showing in those apps, and just be smart about your shopping, really. Anyway, I'm sure you as listeners know most of those, but it's nice to have a little roundup, a little summary, a little reminder. It's been good for me, actually, because I'm guilty of not taking advantage of those myself. Harvey, thank you so much for coming on the pod this week. I'm going to bid you farewell.
Thanks, Andy. Thanks for having me.
And so as quick as that, Harvey's gone, and with the magic of editing, Lauren's joined me in the studio. Lauren, welcome back to the show. You're going to be talking about a few things actually today. So what is it you've come here to talk about? What are we saving money on, Lauren?
So one of the main things I'm going to be talking about today is pet insurance. So if you have a pet at home, then that is likely to be one of your household bills. I mean, I have a pet at home, so that is something that I factor into my budgeting every month. And it is a bill that you could potentially save some money on. And a lot of people, if they were looking to cut back on their household bills, they may consider getting rid of pet insurance as a whole. But I would suggest to consider before you rush to do so, just because if you do need to make a claim in the future for your pet, or if your pet is poorly and you have to take them to the vet, then you could then be left with a really large vet bill. So just a few things that I would consider before looking to either cancel or change your pet insurance policy. Is your pet poorly? Does your pet have any condition? If your pet has a chronic condition and you have a lifetime pet insurance policy, then I would strongly advise that you look into this before choosing to change provider, purely because once you have a chronic condition and you have claimed for it on your pet insurance policy, you will not be covered again. So if you choose to change provider, it will now be deemed as a pre-existing condition, no matter what your pet insurance policy is. The only difference with a lifetime pet insurance policy is that you can continually claim for this condition now each year for the lifetime of your pet. With any other pet insurance policy, you will have veterinary fee limits, which will maximise how much you can claim for your pet's condition. And on some of the policies, you also have time limits. So once you reach the limit, you can no longer claim for that condition. So one thing I would suggest is to have a look and familiarise yourself with what pet insurance policy you have, because if you have a lifetime one, then you may need to consider before cancelling or changing pet insurance provider, because this will affect if you're able to claim in the future. Another thing that I would consider is, how old is your pet? If you've got an older pet and your pet insurance policy is really expensive, then this is something you could potentially consider cancelling if it's not worth making a claim. So, for example, sometimes if you look at your pet insurance policy, if your pet reaches a certain age, then you may have to pay a percentage contribution towards the cost of the claim. Now, in some instances, this is payable as well as your policy excess. So it could mean that if you're paying, say, £500 for your vet fee bill, you could end up contributing as much as £250, £300 to the bill anyway. So in this instance, you may want to consider putting some money away instead of having your pet insurance policy.
And that's on top of the actual insurance that you're paying each month as well. So when you actually tot it up over the year and you've made a claim, let's say like you say, you paid maybe £200 or £300 towards a 500 claim. Well, hang on a minute. You're also paying maybe 20, 30, 40 pounds a month for that insurance policy itself. You're still possibly going to be worse off by actually having that policy. So I suppose what you're saying here is do the maths, do the numbers. Is it worth it? Obviously, our pets are hugely important to us. And as they get older and grow older, you want to support them and love them as best you can. But, it is also still a numbers game. And actually, we're not saying that you're going to put your pet down. What we're saying is put that money into a separate account, a savings account, and see if that works better off financially for you, right?
Yeah, and I think it's really important to do those numbers. And in some instances, say if your pet is young, we can't predict what's going to happen to our pets. We can't predict any illnesses or injuries that they're going to sustain in the future. But if it was a really expensive bill and your pet was quite young, you would have to put away a hefty amount and you would get rid of that savings fairly quickly. But if your pet is older and you've taken into consideration the cost of the percentage contribution, the excess, and the amount of policy you're paying, it might not actually be worth it considering how much you're going to have to pay for the bill anyway. But I think pet insurance is really important, and I think that you should have pet insurance if you have a pet. I do think do the numbers if your pet is older, but if your pet is in general good health and is quite young, then I do think it is quite important to have a pet insurance policy just to cover you in the event that you do need to make a big claim in the future. And that's purely from personal experience. I've had pets in the past. My mum's dog, she's got a Labrador. When he was 3, he had an operation for elbow dysplasia and it cost my mum £5,000. Now, she would never have had £5,000 sitting in an account waiting to pay that bill, just because you don't expect to pay that amount of money for your pet. But because she had a pet insurance policy, she was able to cover that. But if you are going to have the pet insurance policy, there are a few things you could do to get a good deal on your existing pet insurance policy when it comes to renewal, for example. So if you have more than one pet, you could get a multi-pet discount. You could increase your co-payment. So you could increase the percentage contribution that you're paying, which is the policy excess. So you could have the higher the policy excess, usually the lower your monthly premium. And in some instances, you can also choose to pay a percentage co-payment in addition to the policy excess. So what I was just talking about, this is normally standard for older pets, but if your pet is younger, you can choose to contribute more. This will bring your monthly premium right down. But you do have to remember, if you do have to make a claim on your pet insurance policy, this is the amount that you will have to pay. So you have to factor that in as well. Spaying or neutering your pet, that can reduce the cost of your pet insurance in some cases because it reduces the risk of certain conditions. And just one of the main things is just check you've got the right cover for your pet. As I said earlier, if your pet is a specific breed that's likely to have any chronic conditions, then make sure you've got some kind of lifetime cover to cover your pet for the duration of its life, because you don't want to under-insure yourself and leave yourself short if you need to make a claim.
I think there's some really good tips in there. And so another quick tip from me, something I did, is if you're buying pet insurance for the first time, not only shop around and do check Money to the Masses website for that. Lauren's done a load of research on the best, the cheapest types of cover, what the different types of cover are. But one quick tip I would give is once you've done that shopping around, have a little look on the cashback apps and things like that to see if you can actually get some cashback as well. I mean, there used to be cashback policies and they seem to be few and far between now, but you can still get cashback on the actual policies themselves if you buy them through, say, Quidco or Top Cashback.
Yeah, there's just one more thing that I wanted to add on that as well. If you do find yourself struggling financially, there are some charities that can help you with the cost of veterinary treatment. Now, these charities are obviously very stretched and they are designed to help those who are on benefits or income support. So if you do find yourself struggling financially and you need a bit of help in hand, then you do have the option to take your pet and register with the charity such as the PDSA to be able to have your pet treated, and you get a bit of help towards the cost of veterinary treatment. Usually you're asked to make a donation, but it depends how much help you need with your benefits and your income support. So that is something to consider, but those charities are there for those who need the help, so they shouldn't really be used if you can afford to have pet insurance or pay the treatment yourself.
Okay, so I think we've pretty much covered pet insurance there. One final thing from me is that if you're committing to pet insurance, make sure that you can claim on that policy. If you've decided the pet insurance is for you, so do what Lauren suggested earlier, make sure that the type of pet you have is covered, all of that kind of stuff. But another thing that's really important is to make sure that you check the T's and C's, because a lot of these pet insurance policies insist that you have to have your pet taken for annual health checks and that they have their worming and flea treatments. So if you don't do that, that can invalidate your policy. And actually, if you're thinking of getting a pet, factor that into your monthly cost, because I didn't factor it in. I'll be honest. I looked at pet insurance and how much food costs, and then I put a budget away and I thought, right, my pet's going to cost me this. And then suddenly 2 or 3 months in, once she'd had all her jabs and everything else, the vet said to me, okay, well, what worming treatment are you going to use? What flea treatment? And that was another consideration. And that was an extra £15 a month that I hadn't budgeted for. So just think about that. Make sure it's in your budgets. Make sure you do it, because it will invalidate your insurance if you don't. Right, Lauren, let's move on then. So we've done pet insurance. You're also our travel insurance expert. Now, less people are traveling, we know, but things are opening up. Hopefully we can all get to go on holiday wherever we want sometime soon. So travel insurance is not strictly a household bill, but it is something we'll all be thinking about soon, I'm sure. Any tips on travel insurance, how to save money?
Yeah, I'm definitely thinking about travel insurance because I'm dreaming about a holiday and getting out of the UK. But having a look around travel insurance, there's a few things you can do if you want to kind of reduce the cost of how much you're paying. Travel insurance is an essential to your holiday, so do not cut back costs on travel insurance. I can't stress that enough. Some people think that it's not needed, particularly if you have an existing European health insurance card, which has now been replaced with the global health insurance card. But one thing that I would say is that when you are looking to go away, shop around on all of these comparison sites and have a look to see if you can get a good deal elsewhere. Remember that the comparison sites are not always whole of market, so some of the travel insurance providers aren't on there, so you may get a better deal going with them directly. Another thing to consider is if you are hoping to go away more than once in a year, then you could consider an annual insurance policy instead of multiple single trip policies. And then touching on that as well, if you're going away as a family or as a couple or in a group, these policies may be cheaper than multiple single trip policies. But one thing to consider is if a member has pre-existing medical condition, then that could obviously in turn increase the cost of your policy. One thing to consider is you must declare all pre-existing medical conditions that you have, and not doing so, even if you have to claim for something not related, could invalidate your travel insurance policy. And I know if you have a pre-existing medical condition, this can obviously increase the cost of your travel insurance policy. But there are a lot of specialist providers out there now that offer travel insurance for certain pre-existing medical conditions. And the website Money Helper has a directory that has a lot of information about travel insurance providers that offer them for you. So go and check that out. Another thing that I would say is make sure that you are definitely covered for what you need when you travel. So if you're going on a winter sports holiday, make sure that you've got the right amount of cover, because that could leave yourself short. Finally, another thing to consider is to double check that you're not over-insuring yourself and not already covered for your travel insurance in a package. So a package with your bank, for example, some of them have package deals which will include a travel insurance policy. So make sure you're not double insuring yourself.
And that actually is a really good tip, and it kind of moves us on to the next part that you're going to go on to, which is talking about those packaged accounts. Now, a package account is what banks will often provide to its customers in order to give some benefits. And you mentioned travel insurance there. Sometimes you'll get mobile phone insurance on top of that as well. And there'll be other deals, maybe AA, breakdown cover, RAC, that kind of thing. And to people who use all of those benefits, it can be a really good way of saving money on insurance products. And the fees from the banks will range normally somewhere between sort of £5 and £25. But Lauren, I suppose what's important here is for people to actually evaluate what they've got, how much it's costing, and whether it's worth it, right?
Yeah, so I would definitely take a look at what your package includes, because you could shop around to potentially save money elsewhere. You could get cheaper phone insurance elsewhere. Your travel insurance may be cheaper elsewhere. So are you actually utilising and using all of the things included in your package deal? Because it may work out cheaper. For example, you may not be travelling in this particular year, but you're paying for travel insurance. So would it be cheaper for you to cancel your package deal and then just get phone insurance elsewhere? That may be half the price of what you're paying for your package deal. So yeah, I would definitely take a look at what you're doing.
And that's actually something I did a couple of years ago when I started using the Emma budgeting app, because one thing it's really good at is highlighting subscription fees, and it sort of annualizes those subscription fees up. And it noticed I was paying £20 a month for my bank account package account. And when I realized realised that, I actually thought, wow, let's sort of dig into the numbers. And it was quite easy to do. I contacted my bank. I said, I no longer want this. I had to tick a few buttons because effectively I had to change the type of bank account that I had. But effectively I had to move across into a different account, which actually at the time meant that I had to have a different type of debit card. So it wasn't too arduous, but you do have to do a few things to move across. Lauren, I mentioned sort of mobile phones and you mentioned mobile phone insurance. There's a couple of tips quickly, isn't there, on mobile phones and whether it's worth paying the money that you pay each month?
Yeah, so one thing I would do, when your phone contract comes to an end, it may be 1 or 2 years, then you could look at SIM-only deals. Now, what I did is I was able to log into an app on my phone and it told me how much internet I'd actually used each month. So I could see how much I needed to take out on a SIM-only deal. And because I'm on Wi-Fi quite a lot, I'm on Wi-Fi in the office, I'm on Wi-Fi at home, I wasn't using a lot of internet. So I was able to reduce my SIM-only deal by quite a lot. And I think now I pay something ridiculous, like £9 a month for my SIM-only deal. And when you look at what you were paying for a contract, which is, they're really expensive, £40 to £60 a month, that's a massive saving, which you can then obviously put away or spend elsewhere. And whilst we're on the topic of mobile phones and travel insurance, actually, there was a recent announcement that there's going to be some EU data roaming charges. So remember back in the day when you used to go abroad, you're like, quick, before you land, turn off data roaming charges before you get a hefty bill. So those days are upon us again. Some of the mobile phone providers are reintroducing those charges. So I would definitely have a look at your network provider and see if they're reintroducing those charges. I know my network provider is, and that is something that is a bit of a shame really, because it did save you a lot of money when you were abroad. You could use your phone as normal, but definitely double check that, particularly if you're going away this year.
And actually your previous life and being a flight attendant, that would have been a real kicker for you, constantly landing in other countries and desperate to get on Wi-Fi's and save money, I suppose. Thank you so much, Lauren, for coming on the show. And keen-eared listeners may well have heard a special guest in this week's podcast, because Lauren mentioned at the start of the show that she's got pet insurance, she's an animal lover. Well, Kato, the dog, has been sleeping beautifully in the background and creating a few snoring noises, so that Lauren hasn't got wind. It's just it's just Kato in the background. So it's really nice that Kato joined us, Lauren.
She wanted to get on the podcast.
Yeah, absolutely. So Lauren, thanks ever so much. Right, Laura, we're going to be chatting to you next, and we're going to be covering things like mortgages and credit cards. So Laura, welcome to the show.
Yeah, thanks, Andy. Great to be back on again. So I guess let's jump straight in with mortgages. For most people, that's going to represent their biggest monthly outgoing. And it is an area where you can save a significant amount of money. Still, far too many people are on the lender's standard variable rate. So this means that you'll take out your mortgage on perhaps a fixed rate or a tracker rate that has a particular introductory initial offer. Then when that comes to an end, you will automatically move on to the lender's standard variable rate, which is typically significantly more than you will have been paying. And it really does pay to look to remortgage, to find a more competitive deal, to move on to another one of these fixed rate offers or tracker rate offers where you're going to benefit again from a lower initial rate. I've managed to save money in the past by doing this, and by being aware that fixed period is coming to an end and actually acting a couple of months before you know your deal is going to end to start lining up the remortgage. So that's my first tip really, is just to keep on top of when those deals are going to come to an end. Start either looking around yourself or using a mortgage broker to find a good remortgage deal. And a secondary thing to look at is, when you are remortgaging, to look at the fees that you're going to be paying on your remortgage deal, because that can make a significant difference to your monthly repayment and also the total amount that you're going to repay over the lifetime of the mortgage loan. So some of these fees, they might be called product fees or arrangement fees. Different lenders give them different names. They can be anything up to around £2,000. Some may be a bit lower than that, and you'll be told that up front what that fee is going to be. I think that the issue is, for a lot of people, because you can simply add that fee onto the mortgage, it almost seems like because it's not something you have to pay up front, it's easy to kind of dismiss it in your mind as like it's not really a large amount, it's not a significant amount. But the problem with adding that several hundred or couple of £1,000 onto your mortgage is that you're going to be paying interest on it at the same rate as your mortgage rate for an extended period. So say you've got a 25-year mortgage, you're going to be paying interest on that product fee for the full 25 years. So it is really a case of balancing whether you want to pay that fee up front or whether you would prefer to add it onto the mortgage and perhaps try and make use of the fact that you can typically overpay your mortgage by up to 10% per calendar year and just make a concerted effort to start chipping away at that extra bit of borrowing as soon as you can. So those would be my two main tips with mortgages, is to look to remortgage to get off of the standard variable rate, to really look at the fees and balance whether it's better to get a lower rate mortgage with a higher fee or whether it works out better to have a low or no fee product but pay a slightly higher rate. You really just need to do the calculations yourself. Generally, as a rule of thumb, the larger your mortgage loan, the higher fee you can shoulder as part of that. But proportionally, if you've got a much smaller mortgage, paying, say, £2,000 as an arrangement fee is going to be a much bigger part of that debt.
Okay, so that's all good stuff, Laura. And if we actually drill down into interest rates themselves, and because that's what denotes what you'll be paying each month, that's the key thing that people will be looking at. Looking back at 2021, those 2-year fixed deals were coming in at sort of under 1%. But obviously, prices are rising, things are going up, interest rates have actually increased recently just before Christmas. So what sort of rates, what sort of deals will people be looking for in the coming months?
Yeah, no, so as you say, we've seen a base rate rise from the Bank of England. That's slowly starting to filter through to the headline rates that we're seeing from mortgage lenders. Generally, yes, interest rates are going up on those fixed rate deals. There's only a couple of building societies that are still offering under 1% 2-year fixed rate. And that's still for people who can afford to put a 40% deposit up against the loan. So yeah, it's becoming a little bit tougher. Having said that, I mean, relative to history, mortgage rates are still very low. And I'd say that if you are looking to remortgage, it does seem to make sense to look to get onto a slightly longer fixed rate term. Try and fix now, because all indications seem to suggest that we are going to see further rate rises over the course of this year. Obviously, I haven't got a crystal ball. I don't know when they're going to come or to what level rates are going to rise. But it seems to be clear that with inflation still high and with the post-COVID recovery stronger than anticipated, that we are actually going to start seeing those rates creep up over the coming year.
Okay, so you mentioned earlier mortgages are pretty much everyone's biggest outlay each month, and another big thing for people is obviously other debt, so probably credit cards, things like that. Are there any tips on what people can do to try and shave off what they're paying off their credit cards? Obviously, the tip we always give is to pay as much as you can, pay more than the minimum, try and make sure you get the best deals on your credit cards. But Laura, you're going to dig into that a bit deeper.
Yeah, especially at this time of year, post-Christmas. I know I've had a really expensive couple of months. I've recently moved house, had Christmas, and, you know, perhaps put a few things on my credit card that I'm now looking to pay off. And a really good way to do that, if you have a bit of debt built up on credit cards or store cards, is to look for a good 0% balance transfer credit card deal. There are some really competitive ones out there at the moment. So, for example, Virgin Money has a 35-month interest-free period on its balance transfer card. So you've got almost 3 years then of not having to pay any interest on that debt. And as long as you make the commitment to making those monthly payments, budgeting so that you know that you're going to clear the full debt over that time frame, you can stand to save a significant amount of money. With that card, there is just under 3% balance transfer fee, so you need to factor that in if you are looking to transfer a larger sum. But generally, it is a good way to get on top of your credit card debt and, as you say, to reduce the overall amount that you're paying on that debt. If you're looking for a fee-free option, then Sainsbury's Bank has got a 21-month balance transfer window available. So you won't pay any fee to transfer the money, but obviously you've got slightly less time to repay the debt. So you'll really need to look into whether you're going to be able to clear all of that debt before the end of that 21-month period. And generally what I'd say with these cards is they're a really useful tool, but you do need to be careful with how you use them. So, for example, if you are late making a payment, if you miss any payments, then it's often the case that you will automatically lose that introductory deal and you'll immediately have to go on to paying the full APR, which can be a bit of a shock to the system if you've factored in that you're going to have 3 years interest-free payments on this debt.
Yeah, and just a quick tip on that from me, just from personal experience recently, I've got some debt on a credit card, and actually the reason I've got that debt on the credit card is I decided to buy my lease car a couple of years ago, and rather than finance it through a personal loan, I did it via a money transfer credit card and put the money into my account, because actually financially, in terms of the actual percentage, it was actually slightly better than a personal loan. And maybe actually, Laura, I might be stealing your thunder, that might be one of your tips in a couple of minutes, but I did that, and so it was up for renewal in terms of I wanted to move that debt across to another credit card because the interest rate was just about to kick in. My interest-free period was actually up. And because it was quite a large amount on the original credit card, it made more sense for me to split that debt down and split it over 2 credit cards. So I wasn't putting all my eggs in one basket. And so I actually decided, my wife and I, because we have shared finances, we were going to put half on my wife's name and half on my name. That actually turned out to be more tricky because the original debt was in my name. So when we got the 2 credit cards and we tried to transfer half of the debt onto my wife's credit card, it came back and said, well, they couldn't do that. The particular terms and conditions on that credit card were that the debt couldn't be transferable from a different person, even though we have joint finances and it's from the same bank account. So that caused us some challenges. It was something I had to think about. We ended up having to apply for a new card. And, you know, these things can affect your credit rating. So it's just not really a money saving tip. It's just things to think about when you're doing this transferring from one card to another. Laura, have you got any sort of other ideas and tips on credit cards and money transfers, that kind of thing?
Yeah, that's a great point. And I think it is quite a common stumbling block for people that you see these headline rates, you see these offers, and they're really attractive and you can automatically see how they could work for you and work for your finances. But you do really need to look into the terms and conditions because in actual fact, take for example a particular interest rate, the lender only actually has to provide that headline rate to 51% of applicants. So you may not be given that particular interest rate. I mean, similarly, often with these interest-free periods, you need to focus in on the language that the card provider uses. So many of them will talk about up to a certain number of months, but it's not guaranteed that you will actually get the full interest-free period. It can be subject to status, and perhaps if you haven't got as good a credit rating, you may get offered a lower amount of time, which can have a big impact on you if you've budgeted to have that full period. Yet similarly with interest rates, you might be offered a higher APR than's advertised. So you really need to kind of dig into this before you apply for the card. And as always, I'd always recommend that you use the online eligibility checker so that it does a soft search on your credit file. And if you are going to be turned down for a card, it's not then going to affect your overall credit rating with the credit reference agencies.
And so there we have it. Thanks ever so much, Laura. We saved the most exciting stuff for last. Well, no, maybe not. I mean, look, what we have saved to last is the biggest potential savings that you can make, because these are big bills we're talking about here: mortgages, credit cards, debt. If you can shave off the amount you're paying off your debt, then you're going to be significantly better off going forward. So it's important that we cover it.
Sorry, it's very hard to make mortgages and credit cards glamorous, but it may not be that exciting, but hopefully our listeners have found it helpful.
So that's it. We're done. So if you want to get in touch with Damien, you can do so in the usual way. It's damien@moneytothemasses.com. Now, I know Damien wasn't here this week, but he will be back next week. He will be checking his inbox. You can send him a get well soon message if you like. You can provide feedback on the podcast, questions, things for us to cover in future podcast episodes if you like as well. We've also got the Facebook group. Don't forget to have a look at that. Join our community. It's facebook.com/groups/money to the masses. We've got the YouTube channel. Oh, before I forget, we've also got the 28-day financial fitness challenge over on Instagram, but we also cover it in full on the website. If you're not on Instagram, that doesn't mean to say you miss out. Check out moneytothemasses.com, put in 28-day challenge. You will see the details in there. We'll put links in the podcast as well so that you can follow that along with the rest of us. Laura, thanks again for coming on the show. I'm going to say it to you this week. So until next time.
Until next time.